Hey guys, it's Josh. We're checking in with Nick and Jessica, co-founders of DataTrek Research. They are the authors of DataTrek's morning briefing newsletter, which goes out to over 1,000 institutional and retail clients. Nick and Jessica also have their own YouTube channel, which we're linking to in the description below. Hey guys, good to see you.
Good to see you.
Hi Josh, thanks for having us.
So I want to hear about Switzerland. I've never been there. Where exactly did you go and how long were you there for?
We went to Geneva for the week, saw a bunch of clients, very constructive set of meetings. It's a beautiful city, as I'm sure everybody knows, and very clean, very orderly, very Swiss. It's a real pleasure to be there.
My understanding is Geneva is like the French part of Switzerland and Zurich is more German, or is it not really that way?
It is that way.
No, that's exactly right.
It is.
Okay.
Geneva's like, 30 minutes an hour driving from the French border. There's actually a border control between the two because Switzerland's still nominally neutral. But it's very close to, and they speak French.
Okay. All right. Very cool. I'm going to have to add that to my list. Jessica, I loved following your pictures. What was the coolest thing that you did while you were there?
Honestly, we went over to France for a little bit. There's a drop zone there within an hour away, so I did some skydiving. So I loved that.
Okay. You got to practice your sport while you were there.
But I guess in Geneva, we went to the Patek Philippe Museum. So if you do go to Geneva, definitely go there. It's awesome.
Okay. And I assume there was some chocolates involved as well?
Oh, yeah.
Yeah, sounds like, okay. All right. I want to talk about, so we're like halfway through 2024. And I think one of the biggest misconceptions that I hear from people about 2024 is that something is somehow off, or there's something wrong with the way markets have behaved so far. And I just don't see it. What I see when I look at the big picture now is earnings growth, CapEx growth, healthy profit margins, revenue holding up. I won't say revenue growth to the extent that we've had in prior quarters, but it's still up there. Labor market hanging in there. Consumer spending is solid. Wage growth is normalizing. So it's not blistering, but it's okay. None of this seems inconsistent with a rising stock market. Companies have gotten the message on rising prices. They're pivoting back toward value options, but we shouldn't interpret that as companies are girding for recession. So I keep hearing that like something is strange or off. It felt textbook to me. And then you guys looked at the picture and concluded this is kind of a normal year in the market. So Nick, do you want to kind of set the stage for us?
Sure. Yes, you're right. It is a freakishly textbook year so far, so much so that I think we would look at it and say there's almost something wrong because it's running so true to form that it's almost strange in that respect. But
is it running like a Swiss watch?
It's running like a top Swiss watch. So just a couple of sound bites, because we've talked about these topics on prior versions of this video. And for example, we worried back in March that March was the peak, and Jessica had a discussion with some data that showed 80+% of the time the market peaks in Q4. And sure enough, as kind of wrenching as the period after the March quarter end was, we're at new highs now. So March wasn't the peak. Large caps are outperforming small caps. S&P's up 15, Russell's up 1. That's the same as the 1, 3, 5, and 10-year track record for the relative performance of those two types of U.S. stocks. The RSP.
Let's pause there. People have this misconception that they're supposed to match each other. And it's not that way, is what you're saying.
It is not that way. Small caps have their place. They do well off the bottom. They do well when high yield spreads are coming in. They don't do as well as large caps during the middle part of a cycle. And we've talked about mid-cycle markets on past videos, and this is still a mid-cycle market. So large caps are outperforming. Same goes for the equal weight S&P. We talked about that on the last video. That's still underperforming, only up 5% for the year. Again, same as the 1, 3, 5, and 10-year track record versus the market cap weighted S&P. You've got U.S. doing better than rest of world. Rest of world's up 4% of the S&P's 15. Same as the last 1, 3, 5, and 10 years. Same story. The VIX has been running well below the 20 average level. Again, that happens during mid-cycle markets, and it's still doing that now. It's not complacency. People think a low VIX is complacency. It is not. It is how stocks trade during the middle of an economic cycle, during a part of a business cycle, and that's where we are today.
So it's not. So you're saying this is not an anomalous VIX.
This is not
a VIX sitting on 12 doesn't mean something's wrong or something's off.
No, it tells you that the market believes, and I think rightly, that we're in the middle of an economic cycle. There's no recession imminent. It's a big concern. We heard that from a lot of Swiss investors, honestly, that a U.S. recession is imminent because we've had 5 years of expansion or 4.5 years. But it isn't. The market sees that. The Fed's getting ready to cut rates. So you have a low VIX. Gold's been working this year. Gold's up 13%, better than rest of world stocks, better than small caps. Not an anomaly. That's happening because central banks around the world are buying gold because they see it as a dollar-based asset that can't be confiscated. So there's a good fundamental case for gold, and we did a whole video of that on our channel. And then lastly, maybe the most interesting thing and maybe the freakish thing is that valuations are higher now than in 2019, right? S&P's trading at 20 times earnings versus 18. 10-year yields 4% now, was 2% before. And that tells you that maybe interest rates don't have the effect on valuations that we think. Ultimately, stocks trade on innovation and growth, and we're getting that. So the PEs are higher regardless of higher rates.
If you would have given me this list of things from the VIX to gold, et cetera, maybe the one that I would have had the most trouble believing, if you would have told me in January, we're going to see what rates have done on, let's say, the 10-year, which is like this kind of universal, it's the sun in the solar system for how we discount all the other assets. So you're going to tell me the 10-year is going to go from 2 to 4%, and the PE multiple on large cap stocks is going to go higher. It would have been very tough for me to process, but that is one of the big stories of 2024, multiple expansion for the S&P. I wonder, though, how sustainable is that? We're not going to get the next 20% out of the market from more multiple expansion, are we?
The next 20%, no, but the next, say, 5 to 10, entirely possible, because ultimately, the role of rates, I mean, if you want to get really technical, the way you do valuation is you look at the discount rate, which is the treasuries plus the equity risk premium, but then you have to factor in a growth rate. People forget that part of the equation. And the growth rate can be just as important. And a growth rate that goes from 1 or 2% growth to 4 to 5% growth, structural in an index like the S&P, has a profound effect on valuations, and it swamps 50 or 100 basis points on the 10-year.
So when people ask you about the second half of 2024, what are you giving them in the way of guidance?
We're telling them that obviously we've had huge gains for the first half of the year. We see further gains because the markets don't top out until October, November, December. So that's the way markets work. At the same time, we've had this huge run in tech. It's entirely logical to think we get some kind of pullback in tech. And we're seeing some of that now, especially with Nvidia, which we'll talk about. But you're going to see some rotation back into some of the laggard sectors. The other sectors that work mid-cycle are financials and industrials, and sometimes healthcare. But financials and industrials tend to be the plays during the mid-cycle on top of tech. Still large cap over small cap, still market cap over equal weight. So some mirror of the first half, but perhaps with some catch-up trades in some of the less loved groups as tech gets cycled out of, call it the next 2 or 3 months.
If somebody believes in that story, they have to do something other than SPY, because you could end up with a scenario where tech bleeds market cap to industrials or financials or healthcare in line with where we are in the cycle. The index doesn't gain much ground, but a lot of people make money in the beneficiaries of that rotation.
That's entirely possible. And again, that was a big conversation with the Swiss clients that we met, because all of them are looking for that either value rotation or sector rotation. They're looking at it from a number of different perspectives, and not just in the US, but around the world as well, because the dynamic that we're talking about is kind of universal. But at the same time, we're always reluctant to say, okay, you got to be long financials for the second half, because even though we like the group, at some point, tech after its rest has one more rally in it, and that's what takes us to new highs in the fourth quarter. So it's really tricky to judge that rotation. We're seeing it now. We're seeing it this week. We'll probably see it the rest of the week as we wrap up Q2. But it's very hard to say, okay, that's the trade for the rest of the year. So you got to be really nimble in these calls.
Yeah. We're going to have the first of 2 presidential debates this week, Thursday night on CNN. What do you think is the not the message for the market, but how do you think markets will process the fact that we've got this U.S. election coming up, and basically it looks like a coin toss right now, depending on whose polls you look at? What's the effect on markets as a result of having this hanging over our heads?
This was probably the number one issue that our clients in Geneva wanted to talk about, because obviously we're coming from the U.S.
Can't believe it.
Yeah, this was a good third of every discussion, and usually the top third. because they view it in the context of what's happened in France, what's happened in the UK, what happened in Mexico, what happened in India. They've seen political turmoil. These are very global investors, so they're very sensitive to this. The general consensus, which I think we share, is that it's not going to have the same effect on capital markets that it did perhaps in the UK or France, particularly with French bonds and French stocks, because the underpinnings of the American economy are just stronger. There's a real respect for what America has created in terms of an entrepreneurial culture, in terms of a business culture that almost overwhelms the effect of politics on markets and on economic behavior over the medium term. So if you see some kind of disruption, who knows? It's going to be very unpredictable in the next couple of months in U.S. politics. But you see any kind of disruption, that's a buying point because that uncertainty is temporary. And what's permanent is American entrepreneurship, growth, technology, the kind of things that have lifted the market all year.
I want to throw up an oil chart here. This is actually energy stocks. John, on screen. Energy has been underperforming by 6.8% year to date. Nick, you and I have talked about this idea that you never want to get rid of your energy stocks because those are your only true hedge against an oil price shock. And obviously the history backs that up, but there are periods of time where that energy equity exposure does feel like it's very expensive. But I thought this was interesting in that if we get some sort of a reversion here, that could be one of the better tactical opportunities so far in 2024 to do something that looks different than the market. Chart off. What do you think about that?
Yeah, it's a very fair point, and you're right. I mean, there's not a lot of ways to insure for an oil shock recession. Energy stocks are basically the only way. It worked in 1990, for example, and it works really fast when it works. Because when everything else is going down 10%, energy is up 10%, and it's the only buttress. And if you're underexposed energy, you're going to get hurt more than most. The one thing I'd say is that you now see energy prices heading back up, oil prices heading back up. There's increasing disturbances in the Russian oil production system from Ukrainian attacks. There's also the lingering threat of a Middle East conflict that kind of spills over into something else. So as unpleasant as it is to own an underperforming group, you can't be underweight energy for the reasons we discussed. The other thing I'd say, energy is the second best performing stock since the end of 2019 when you reinvest dividends. It's only beaten by tech. And if there's one sector where you just hit reinvest on the option on your brokerage account or as an RIA or an advisor, it's energy. You need to reinvest those coupons because it pays a pretty high dividend, roughly 3% right now, so more than double the S&P. And that reinvestment really helps returns dramatically. So energy is one of those groups where you have to reinvest dividends. It's probably the only one I'd say you have to, but that's the one where you have to because it means
even more important when they're in a bear market.
Absolutely.
That's when you really want to make sure that you're doing that.
Yes, because I mean, energy just price base is up like 22% since the end of 2019. When you reinvest dividends, it's up 80%. Second best performing group.
I just want to hear from you guys on Treasury yields in the second half. So your view is that, I'm just going to quote you, rising real, meaning ex-inflation yields explain 90% of the increase in 10-year yields since the end of 2020. They are up because the Fed has stopped buying bonds and because economic growth has been decent. Not much chance either will change dramatically in the second half of 2024. You want to, like, for the people that don't focus so much on fixed income, you want to give people a little bit of an idea of what you mean when you talk about the explanatory power of real yields.
Yes. So when you look at the yield on a screen and you see 4.2% for the 10-year, that's decomposed into two factors. One is expected future inflation over the next 10 years. And that runs at a very constant 2.1, 2.2%. Been very constant over the last 20 odd years because that's the Fed's target. Bond market takes that as kind of gospel, 2.2. The balance of that when you subtract is what we call real yields. How much are you getting paid above inflation expectations? That's currently running exactly 2%. We haven't had 2% prior to the last year or two since the 2004, 25, 2006 range, so pre-financial crisis. Real yields have topped out at 1 in the 2010s. So now we're back to 2 because the Fed's not buying bonds because inflation's the Fed has decided that real rates have to be high, because they're not buying bonds, and the market's saying 2% is probably the long-term real rate of interest in the U.S. economy. In a recession, real rates will decline. So you'll get a better return on your Treasury holdings. But in the interim, you're kind of stuck with coupon-like returns. So you'll make 4% over a year on Treasuries because we're probably not going a lot higher in real yield. We're also probably not going a lot higher on inflation expectations. But if you're long a lot of Treasuries, it's because you believe that the recession is coming and real rates will decline, and you'll get paid because yields will go down and bond prices will go up.
Prices will go up. Okay, but you don't see much change in Treasury markets between now and the end of this year.
No, because again, as you said, most of this terrific, horrible bear market in long-term Treasuries the last 2.5 years have been because of real yields. It's not because inflation's moved around. It's because real yields have gone from -1 to +2, and that's what's created the bear market. It's not going to end. Meaning you're not going to start to get a big rally until there's a recession.
So if the number one topic everyone in Switzerland wanted to hear from you guys on was politics, I'm guessing number 2 was Nvidia, tech overcrowding, et cetera. Jess, what's happening here with Nvidia versus the S&P 500?
Yeah, so one thing, now that Nvidia is such a large part of the S&P 500, one thing we wondered about was Nvidia's price return relationship to the broader market. So we sent you guys over a chart. If you could please just throw that up.
Here
Perfect. So awesome. So this shows the trailing 30-day price return correlation between Nvidia and the S&P since the start of 2018. And what it shows is that Nvidia's average correlation to the index is 0.65, but its most recent 30-day correlation is only 0.14. That's basically zero. So there's now no statistical relationship. Nvidia has totally broken away from the US stock market.
I said to myself last week, Nvidia has basically become its own asset class. It's $3.5 trillion. It does not obey any of the rules, seemingly, of the rest of the market. It could be green when it wants to be green. The market could be red or green, and it's almost irrelevant. It almost seemed like it had its own gravitational pull. That strikes me, of course, as being unsustainable, but that was what it looked like last week. So your pointing out of the correlation basically falling to zero is kind of what I saw with my own eyes without having run the numbers.
Yeah, and exactly to your point, we wondered, how did Nvidia end up performing after these instances that because it's very unusual for it to have this low of a correlation. So if you throw up the chart one more time, so it's super unusual. It's only happened 3 other times since 2018 that Nvidia's 30-day price return correlation to the S&P has been this low. So we looked at the weeks and months after these instances and found that the picture is really mixed. So for example, after it happened in September 2018, Nvidia did go on to decline, but that's because it kind of got caught up with the bear market in Q4 2018 when you probably remember when Chair Powell had the Fed policy mistake of overestimating the neutral rate of interest. The other time was in December 2020. Nvidia was basically flat in the 5 days, 30 days, and 60 days after. And then the last instance it happened was in July of 2021, where it lagged the S&P by a few points over the next 5 days, but then it outperformed by a few points over the next 30 and 60 days. So it's definitely a small sample size, and the results were mixed here. But our overall takeaway is that history says as long as the broader U.S. equity market holds in okay, Nvidia is not necessarily going to fall apart, even though its price return correlation to the S&P has been so low. Now, of course, it could fall apart for many other reasons, but this is not one of them.
One thing about Nvidia that makes it really difficult to go by history is that it's a very different company today than it was in those prior instances. In 2018, if you were to ask the analysts covering Nvidia what the big variables were for its outlook, they would all be related to the video game console business. And consoles were either in an up cycle or a down cycle. And then if you were to ask people in 2021 what they're trading Nvidia on, you would hear people say Bitcoin mining. So now, arguably, the company is selling into much bigger, much better markets, much better customers, much more, maybe not customer diversity, but maybe maybe wealthier, deeper pocketed customers. And so I think that's one of the things that makes it so tough to look at historically. But like we have nothing else to, that's all we have is the history. So it's a pretty tough stock these days. I wanted to ask you guys about something that you put out a couple of weeks ago, the Sahm Rule Recession Indicator. I won't quote this whole thing, but just what is the gist of the Sahm Rule, guys, and why did you write about it?
Okay, so the Sahm Rule was named after Claudia Sahm, who at the time when she came up with this rule was a Fed economist. And she was looking for a way to understand when the economy was tipping over into a recession. And it's sort of the holy grail of economists is how to predict a recession. And she used unemployment rates, which are kind of a backward-looking indicator, and people think of it as such. But she used it in a very clever way.
They say unemployment is a lagging indicator.
Exactly.
Okay.
So she looked at it in a very clever way. She looked at momentum in unemployment. So she basically said, and she backtested the idea back to the 1940s, and it seems to work pretty well and not give a lot of false positives. Where basically, if your 3-month trailing unemployment rate is 0.5 points higher than the 12-month lows, prior 12-month lows, then you're entering a recession. And it's clever because it's easy to use, it's very intuitive, and it respects the idea that economies like stocks have momentum, either upside or downside. And when momentum in employment and hiring begins to slow, it doesn't just kind of stop. It just goes higher and unemployment rises. And so the Sahm Rule has become one of the sort of more interesting ways to think about how the Fed is thinking about unemployment, because we've heard Powell for the last 2 press conferences talk a lot about how the labor market could change the FOMC's perspective on rate cuts. If the labor market slows down pretty quickly, he'd be more inclined to cut rates. And the Sahm Rule is one way to back into how much unemployment has to go up for the Fed to start taking it seriously.
So let me jump in here and make sure that everyone understands what you're saying. So your example, if unemployment was 5% at some point over the last year, and that's the lowest it ever gets. And then at some point it hits 5.5%, which is that 50 basis point rise in the level of unemployment. If it does that, if it stays at 5.5% for 3 months in a row, that means the recession, the momentum is now to the upside, which for unemployment is bad. And therefore a recession has likely started.
Yep, that's exactly right.
That's the Sahm Rule.
That's the Sahm Rule.
Okay. What was the unemployment low for this cycle? Did we hit 3.6?
Yes.
We did. When was that?
I think the trailing 12-month is 3.8.
Okay.
So, and that was,
that's the average.
Yeah,
that's the average.
That's the starting point for the Sahm Rule, which is that's called 3.8 level, to say, okay, now we've got to be 0.5 points above. So we've got to get to a running average of 4.2 in order to trigger the Sahm Rule and say, yes, we're going into a recession.
What's the expectation for the first week of July? June unemployment. I don't know either. Okay.
Call it 4041. So we're not
I think it's
there
something
yet.
like that.
But I think we have a graph of the Sahm Rule going back, and here is the results. So as you can see, we've gone from negative, which is no recession, to now climbing kind of closer. I think it's 0.37 is the last 2 months. So we're kind of inching our way up to that 0.5 reading. And that's, I think, in one part why Powell is talking about unemployment, because by this sort of very simple metric, but effective metric, we are kind of edging our way into a flashing yellow light.
Guys, is this going to be one of those things, though, where once a lot of people are paying attention to it, because of the fact that it's being observed, it no longer works, or everyone starts front running it and thereby weakening its effect? Or is this the kind of thing where even if everyone's watching it, it still could be meaningful? What are your thoughts on that?
I think the Sahm Rule is kind of understood in economist nerd circles, but not in probably people who write about the Fed, probably not in corporate America. So until you see it on the cover of the Wall Street Journal, you're probably not going to see a lot of a feedback loop between this rule and corporate America saying, oh my God, we've triggered the Sahm Rule. We have to start cutting people because of a recession coming. Okay.
So if you're a believer in the Sahm Rule and that kind of like momentum on the unemployment side, we're not where we would be to say, hey, we really need to start paying attention closely here.
Yes, and the other great thing about the Sahm rule, if you want to put the chart back up again, is we were all so worried about a recession in 2022, right? Look at the middle
Could
of
see
that.
it.
Look at
Yeah.
it. You're like, okay, fine. We got to, what is that, 0.5. So nothing, nothing signaling. And that was absolutely, everybody was convinced there's a recession coming in 22 or 23. And the Sahm rule said, forget it, it's not happening. And it didn't. So score one for the team.
I love that because I hate the fact that people completely discount the unemployment or unemployment reports. They say, that's backward looking. I don't know. I've always seen it as concurrent. I've always seen it as a fairly up to date indicator. Not that I expect it to predict anything, but I feel like it's a better indicator than most others. If we think we're in a consumer driven economy, don't we want to know what the labor? Don't we want to know in real time what the labor market is doing?
Yeah,
So,
we absolutely do. And look, I mean, there's a lot of controversy about the unemployment report, right? We got the two surveys, and people argue about which one's more accurate than not. We just look at the totality of the data and see if it fits with the general economic picture, and it does seem to fit. And it does seem like
yeah.
the economy is slowing, unemployment's rising, so it all fits together.
Okay. And we actually have a link, which we'll include in the description, that people can click on and see this thing as it moves each month. There's a Fred chart that people can go to. It's hosted by the St. Louis Fed. So we'll make sure that people have that access to that link. Jessica, I wanted to ask you about just what's happening between growth and large, small, like these cross currents. I think we gloss over them. Like we talk about the fact that large is outperforming small, or growth is outperforming value, or S&P versus Russell. But I think there's a lot of potential opportunity embedded in these divergences. But talk a little bit about this next chart, because I found this to be really interesting.
Sure, yeah. So there's been a major paradigm shift since 2020 in the types of public tech companies or just other growth companies that investors favor. So this chart shows the 2-year trailing relative price returns between S&P 500 growth and Russell 2000 growth back to 2003. And we used a 2-year holding period just to help smooth out shorter term volatility, which has obviously been particularly acute since 2020. So as you can see from going from left to right, for most of the chart, like 3/4 of the chart, pre-pandemic from 2003 to 2019, small cap growth outperformed large cap growth by an average of 4 percentage points over any given 2 years. And its 2-year returns outperformed 57% of the time over this period. However, since 2020, it's been large cap growth that's beaten small cap growth, and actually by even more, by an average of 15 percentage points over any given 2 years. And what's even more remarkable is that it's outperformed by kind of an incredible 93% of the time over that time frame. The only time that since 2020 that small cap growths outperformed over the prior 2 years was in early 2021 at the height of the spec tech bubble. So over the last 2 years, as you can see in the chart, all the way to the right, obviously large cap growth has outperformed by a lot. It's outperformed small cap growth by as much as 28 percentage points recently, which from a statistical standpoint is almost 2 standard deviations above the long run average. And it's only really beaten small caps by more than now 2 other times. So the first was in September of 2020 as U.S. equities rebounded from the short pandemic-related bear market earlier that year. And the second was in December 2021 after small cap growth briefly outperformed in early 2021, but then lagged as the spec tech bubble popped. But even with both periods of these outsized outperformances, by large cap growth, small cap growth only went on to outperform after the first instance, and really not for long. So I know that's a lot of data to throw at you, but our overall takeaway from this chart is that large cap growth outperformance over small cap growth may be in statistically significant territory, but history shows that doesn't mean that this relationship is necessarily due for, an imminent reversion to the mean. Investors clearly now favor large cap growth over small cap growth, and we really don't see that changing until a new catalyst develops. We think investors will keep paying up for large cap growth superior earnings potential, as well as more recently their better ability to capitalize on Gen AI.
I think it's really hard to come up with a reason for why this should switch and stay switched. I could picture a mean reversion rally in small growth. I just can't picture like a lengthy market regime where we continue to favor small growth. And one of the reasons for that structurally is that the best small cap growth stories will graduate and they'll go from junior high up to high school. They'll become large caps. They'll be unavailable to the small cap growth universe. So that makes it really, really tough. The second problem is, I think structurally the IPO market has made it so that the best companies are doing their early stage, fast-paced growth away from the public market. So if they're not publicly traded when they're doing that blistering pace of growth, bringing on their first million users, whatever the product is, it's really hard. It's really hard to figure out like where will the Russell 2000 get its growth stories from. They're coming public as mid caps, growing up into large caps, and they're almost like skipping this part of the cycle. And then the third thing I came up with is some of this is probably industry related. I don't know what dominates small cap growth, but I'm guessing it's microchips and biotech. Do you think that's part of the reason here?
Yeah, I mean that's certainly something we discussed with our Swiss clients. Just there's kind of a structural headwind to small caps for the very reasons you just outlined. That they graduate into the larger indices. I will say that the one risk though to S&P 500 growth is it's very concentrated. So actually, big tech plus Broadcom makes up almost 60% of large cap growth. So any hit to one of these names, and then investors, may start looking at small cap growth. That's not our base case. We don't see that happening anytime soon. But it just bear in mind, large cap growth is super concentrated, even more so, way more than the S&P 500. That's probably for some investors who are worried about that risk. The S&P 500 is probably a better alternative in that it still has plenty of exposure to growth, but it's not so concentrated.
Yeah, if you buy the large cap growth index ETF right now, you are taking the concentration of the S&P and maybe doubling it, something on the order, right?
Mm-hmm.
Okay.
Exactly.
So, all right. I guess I would just ask you as a follow-up, if there is that kind of mean reversion, it probably doesn't become a new regime. It's probably more of a tactical opportunity. Is that the way that you would see it? Like you wouldn't, if you saw that start to happen, you wouldn't extrapolate that further into, hey, this is going to be a great era for small cap growth all of a sudden.
Well, I think what's interesting is if you think back to the 2010s, I think many people would view that as a time where large cap growth was leadership, but it's actually small cap growth that did better. Now we see large cap growth continuing to do better because there's been a new catalyst in Gen AI that favors large cap growth. So we think that lends itself to it catching the fact that it is catching up now, playing some catch up and some reversion to the mean after small cap growth outperformed in the 2010s. It does make sense again because of the new catalyst of Gen AI.
All right. Love it. Thank you so much. And guys, I want to let everyone know where they can follow you for more. First of all, I want everyone to check out Nick and Jessica's video channel on YouTube. There's a link in the show notes. If you're listening, it's youtube.com/@Nick Colas and Jessica Rabe. And of course, you could subscribe to DataTrekResearch.com for all of the research Nick and Jessica are putting out. And you guys are going 5 days a week?
Always 5 days a week.
Oh, 5 days a week, always. You will never lack for insight if you are subscribed to DataTrek Research. Guys, thank you so much. So glad you had a great trip in Europe. Appreciate you coming on the show again, and we'll talk to you soon.
Thank you.
Thank you.